All right, here we go, guys. Now we got the same facts we saw earlier. Bonds are issued at a premium, so two things come to mind. The cash that we collect, the cash inflow, is going to be greater than the face value. And then the next thing I'm thinking is my interest expense is going to be less than my coupon paid. Okay, so in this example, coupon divided by price, we got a coupon of 10%. Our market rate is 8%. So therefore, when these bonds are issued, as you could see, we collected more than the face value. So what we're going to do is debit cash, the sum of the present value of the principal and the present value of the coupon payments using the market rate, $108,011. Credit your bonds payable, that's your eventual financing outflow, $100,000. And there's our premium on the bonds payable. Remember, your interest expense is really represented by your market rate. So my interest expense is 8%, yet I'm writing a check, my coupon paid is 10%. What's offsetting the coupon paid to reduce it? Well, that premium. How do we allocate that premium now? Why don't we just immediately book it as a gain? Because that would violate the matching principle. So when bonds are issued at a premium, little by little, we're going to use that premium to offset our interest expense. So the coupon paid, take a look at what we're going to do. Now notice, this is called the straight line method. If you guys remember Crazy GAAP, technically that's not allowed under GAAP, but if the amount, the differential between the effective interest method and straight line is immaterial, then it's okay to do it. But nonetheless, you need to just know on the exam, what is the straight line method? We take our premium, $8,111, we spread it over your total number of periods, not years. So these bonds had a 5-year term, semi-annual payments, we have 10 periods to spread out that premium. So we take the premium, $8,111 divided by 10, $811. This is called a constant dollar amount. So we're going to amortize the exact same amount of premium every 6 months for the next 5 years. So notice our credit to cash, here's our coupon paid, $5,000. That would be your face value, $100,000, times our 10%, times a half, piece of cake. Okay, but that is not our interest expense. Notice our interest expense is less than that, $4,189. That interest expense there is going to be my plug figure. When I do the straight line method, I know, well, what's my premium that I'm going to allocate to that first period and every period? $811. So what's going to be our interest expense? If you take the $5,000, back out the $811, therein lies your interest expense of $4,189. And that'll be the exact same journal entry for all 10 interest payments. So 2 payments per year over the 5-year time horizon. Technically not GAAP, but GAAP says go ahead and do it if the differential between straight line and effective interest method is immaterial. So if they give you a math question and you got to amortize the premium, piece of cake. Okay, let's take a look at our next one. Okay, guys, taking a look at an amortization schedule. So, if you just need to, be able to fill in a missing piece of the puzzle, let's just say, how do we always get our interest expense? Our interest expense is always a function of the carrying value of the debt at the beginning of the period times the market rate at issuance, and assuming it's semi-annual, don't forget to divide that by 2. And therein lies your interest expense. If you're doing the effective interest method, that's how we get our interest expense, doing the effective interest method. If you're doing the straight line method, then we're going to back into it as we just saw. Okay, so looking at our amortization schedule, utilizing the effective interest method. So my beginning carrying value, $108,111. My market rate was 8%, semi-annual, 4%. Take your $108,011, multiply it by 4%. There's my interest expense, $4,324. I don't get it though. I'm writing a check for $5,000. Your $100,000 face value times your 10% over 2. Okay, that's going to be the exact same amount. The difference between the $5,000 and the $4,324, that's a little piece of the premium we just amortized. So the difference between the $4,324 and the $5,000, $676. Notice when the bond is carried above the face value, remember you're going to pull it down towards face value. So you would subtract To get to that 107,435, that would be your $108,111 minus the little piece of that premium we just amortized, 107,435. And then you just keep repeating that process. The next period, your carrying value is a little bit lower. As your carrying value gets pulled down, notice what's happening to my interest expense. Effective interest method is called a constant rate method. While the dollar amount of interest is not constant, it's getting pulled down with the carrying value, the rate is constant, 4%, the semi-annual market rate. So again, your $4,297 minus your $5,000, we just amortize another $703. So what happens to your carrying value now? Subtract it, and now our carrying value drops to 106,733. And if you really like this stuff, we could just keep going on and on and on. But I think you got the point, right? So not so bad. All right, let's take a look at our next issue. Okay, so just to recap the journal entries with the effective interest method. So if we were going to record the interest payment for period number 1, we're crediting cash for $5,000. Our interest expense, unlike the straight line method, we have to find this directly. Carrying value, beginning of that period, times your market rated issuance, divided by 2, 4,324. This now becomes your plug figure. Okay, 676, the difference between the two. Period number 2, just as we saw, we're still writing a check for $5,000, but as the carrying value goes down, as you get pulling it down towards par, what happens to your interest expense? No longer 4,324. It gets pulled down, so it's not a constant dollar, it's a constant rate, 4% of whatever the beginning balance is. And then what's your plug figure again? Your premium on your bonds payable. Not so bad. All right, guys, in our next example, journal entries to record interest payments, but this time we have a discount bond. So whenever we have a discount, we're going to collect less than the face value. What are we anticipating? A yield greater than our coupon. So in this particular set of facts here, let's see, the market was demanding 12%. We offered them again only 10%. So we know the bonds are being issued at a discount. So we got 5-year term, 2 payments per year, 10 total payments, 12% divided by the 2, 6%. Let's find our present value factors. Present value of our principal plus the present value of our coupons gets us the selling price of the bond. So as we saw earlier with this example, what was the amount of actual cash collected? We collected only $92,639. Okay, with a discount bond, notice the carrying value is going to get pulled up towards par over time. So whenever you have a bond issued at a discount, so 92 is the cash collected, face value 100. As we amortize that discount, what's going to happen is we subtract a smaller and smaller number, my carrying value will get pulled up towards par over time. Remember, whenever a bond is issued at a discount, 2 things need to come to mind. The cash collected is going to be less than the face value, and your interest expense is going to be greater than the coupon paid. You don't need to memorize. Okay, looking at the facts, the coupon paid is 10%, yet my market rate was 12%. The market rate always dictates your expense. Okay? So in this example, as your carrying value gets pulled up, carrying value beginning of the period, times that constant rate, 12 divided by 2, there's my interest expense. So what we're saying is my rate is constant, 6%, but as that carrying value is going to get pulled up, so is my interest expense. So let's take a look at our amortization schedule now. $92,639, our beginning carrying value, that was our cash collected. We take our market rate divided by 2, periodic rate of 6%. There's my interest expense, first period, $5,558. Yet we're only writing a check for $5,000. What's that additional $558? We just recorded some of that discount. So now my carrying value is no longer the $92,639. We now add to it that $558. Where are we now? $93,198. Okay, that becomes our carrying value at the beginning of the next period. Constant rate multiplied by 6%. My interest expense, notice as my carrying value got pulled up, my interest expense got pulled up. Still writing a check though for $5,000. What's the $592? We just pulled up our carrying value by another $592 to $93,790. We keep repeating the process. And then once we're done with the 10 periods, the face value will be the $100,000. We'll pay off the debt. So now let's take a look. Nice and pretty at our journal entries. Whenever bonds are issued at a discount, your cash is $5,000, yet my interest expense is greater than that. Carrying value beginning of the period times the market rate, your plug figure is your discount. So unlike the straight line method, okay, your plug figure is going to be the discount, the amortization of the discount or the premium. The second period, still cutting a check for $5,000, but as my carrying value went up, my interest expense went up, and then we plug what our discount is. Alrighty, not so bad. Okay, so sometimes you got to read carefully what is the question asking for. So here it says, assume the bonds are issued January 1 of year 3. Okay, so now you just got to watch your date. So the carrying value at the end of the fourth period would be reported at December 31st, year 4. Okay, so just read what period the debt is issued at, and then that'll tell you your carrying value from there. So whenever bonds are issued at a discount, it's your face value minus the unamortized, the unrecorded discount. If it's a premium, then it's your face value plus the unamortized premium. So discount or premium, be careful, watch your dates. Okay, what year are they asking you about? Okay, when was that debt issued?